Rahul Agrawal, the MD at the company, joining in with us. Thank you so much, Mr. Agrawal, for joining in with us this morning on ET Now. Surely a good set of numbers reported by the company in Q1. Strong growth of around 30% for Q1 FY25. Is that something that you're seeing and penciling for the rest of the year as well?
So first of all, thank you for inviting me and having our company online here. I think in terms of growth numbers, these are very much in line with what we are seeing in the industry. There is, of course, an import substitution opportunity which we have, and also there is a natural volume growth that is there across the segments that we cater to, whether it is automotive, household appliances, and other sectors. So I think our growth numbers are in line with that, considering whatever capacity augmentations we have done in terms of debottlenecking and other efforts.
Right. Mr. Agrawal, what I also want to know, because when you look at it in terms of the growth rate that was there in the last couple of years, it was not much of an exciting growth rate, right, for the company. So now what is changing much that, you will see this 30% growth rate continue? And also in terms of the margins of the company, is this growth rate something that you will see continuing, the percent of margin, 13% approximately EBITDA margins?
Yeah, so I'll break up your question into two parts. First of all, in terms of growth of the company, if you look at the last 3 to 4 years, couple of years, of course, was extraordinary performance on account of few COVID years, where there was massive supply chain disruptions, which led to unusual numbers. In the last 2 years, actually, we have had a volume growth, of about 15%. And in fact, if you look at year on year, the volume growth is in excess of 20%. So I think in the previous last few years, previous management, there was not much of volume growth which took place. In terms of what we have done since we took over management control in November 22, we have undertaken a lot of projects for debottlenecking and brownfield expansion. So we are seeing incremental capacities coming online with each quarter, and that adding to the volume growth. The opportunity in the market has existed for a long time and will continue to exist. So we are able to avail of that opportunity by augmenting the capacities that we have managed to do so far. In terms of EBITDA percentages, it's hard to predict exactly what those percentages would be going forward. However, we have a strong market position. I think our spreads generally in the business are quite sustainable. And so long as pricing on raw materials and all of that remains stable, the EBITDA margins could be a function of that. I think in terms of absolute profitability, the company will continue to do what we are doing sustainably.
Okay, obviously, we don't want the exact number when it comes to the margins. Any broad range also, if you could give us, say, 12 to 15%, 12 to 14% would be sustainable for FY25. Anything on that side?
Yeah, I think you can consider that as a sustainable margin. The company is doing multiple things. We have added capacities, like I said, in terms of green debottlenecking. Brownfield expansion will also add additional capacity. We are doing a lot of cost rationalization measures as well. And finally, we have added new blends as well, in terms of new products, which will also enhance our product mix. So overall, keeping all these three factors in mind, we believe that the margins should, remain where they are, or at least improve in the near to medium term.
Right. So 12 to 14% is the margin that you're guiding for. And you were just mentioning that a lot of capacities will be coming online down the year. So if you could just tell us what percentage of your capacity is expected to come online for the rest of FY25, and what is the kind of revenue bump up or incremental revenue that we can expect as and when these capacities come online?
So the capacities will come online during the year. And in fact, some of it has come online, some of it will come online as we go along with each successive quarter. Overall, over last year, the capacity augmentation is to the tune of 15 to 20%. And we will see our volumes also increasing in a similar fashion.
Okay, just one more thing that I wanted to check with you. You were also mentioning about import substitution, right? What I can see here is that a lot of your products that you're present in, still the imports of these products are continue to remain on the higher side. So how do you see that changing going forward?
So we believe that in terms of our own positioning in the market, there is a strong preference from our customers to use our products. In the past, the capacities haven't been sufficient to, satisfy the needs of all these customers. However, as we have even added capacity in the previous year or so, where we have augmented our capacities by close to 30%, we believe that, we have not seen any challenge in being able to do that import substitution. Going forward as well, we believe that that would remain the case, and we should be able to capture additional market as a result of that.
So can we safely say that given the fact that there is import substitution, new capacities coming online, 20% top line growth could be easily achievable by the company in FY25 at least?
Yes, 15 to 20%, like I said, is what we believe is going to be the case, so long as all our projects are completed online, which we estimate today would be the case.
Right, Mr. Agrawal, just a last question from me in terms of your revenue outlook for the next couple of years. Maybe let's say FY27. What is the revenue outlook there as well? What are we expecting? FY24, you closed at around 2,200 crores. What is it that we're looking at over there? And profit outlook also for the company in terms of profitability. What is it that the outlook you have for FY27?
So, revenue many times is a function of pricing of the products. The pricing of the products does move with raw materials. Sometimes, when the raw materials are higher, our pricing also goes up accordingly. It's fairly elastic in that sense. If you make the basic assumptions that the raw materials would remain where they are, then our revenues would increase along with the volume growth that we anticipate, which is 15 to 20% for this year, and we have given a similar guidance for next year as well.
Okay, so 15 to 20% is what you will be seeing as a growth coming in, and okay. Thank you so much, Mr. Agrawal, for joining in with us on ET Now. Surely a pleasure having you in the show, as well as talking to you about the numbers of the company.
If you like this video, then like, share and subscribe to ET Now.